Hello there. Investing in the stock market can be very frustrating. If the stocks you bought are going down and you have no idea why, it's a serious problem. In this video, I'm going to show you how to be more confident in your investment decisions and what really matters when investing in the stock market. Investment legend Warren Buffett believes that investing in stocks is similar to owning a small piece of a business. When you buy a stock, you are essentially buying a share of ownership in the company. As an owner, you are entitled to a portion of the company's profits, and you have a say in how the company is run through your ability to vote at shareholder meetings. Therefore, it makes sense for Buffett to view stocks as businesses, as he is essentially becoming a part owner of the company when he buys its stock. Buffett is also a value investor, which means that he looks for companies that he believes are undervalued in the market. To determine the value of a company, he looks at various financial metrics such as the company's earnings, revenues, and assets, as well as the management team and overall industry environment. By viewing stocks as businesses, he is able to get a more comprehensive understanding of the company and its potential for long-term growth. Mr. Market is a concept introduced by Benjamin Graham, a pioneer of value investing and the mentor of Warren Buffett. Mr. Market is a metaphor for the stock market and represents an emotional and erratic investor who is prone to overreacting to events and changing his mind frequently. In the context of investing, Mr. Market represents the market's tendency to fluctuate in response to news and events. He can be irrational, offering to buy or sell securities at prices that are not necessarily based on the underlying value of the company. The idea behind Mr. Market is that an investor should not blindly follow his mood swings, but should instead try to objectively evaluate the value of a company and make investment decisions based on that analysis. FOMO is an acronym that stands for fear of missing out. It refers to the feeling of anxiety or pressure that can arise when someone thinks they might miss out on an opportunity, especially if they perceive that others are benefiting from it. In the context of investing, FOMO can lead people to make impulsive or irrational investment decisions, such as buying into a stock or an asset that is rising in price and appears to be a hot investment, without thoroughly evaluating the risks and potential downsides. This can be especially true if the person feels they are missing out on potential gains because others around them are making money from the investment. It's important for investors to be aware of FOMO and try to avoid letting it influence their investment decisions. Warren Buffett once said that time in the market beats timing the market. It's more important to be invested in the market for the long term rather than trying to time the market by trying to predict when to buy and sell. The idea is that over the long term, the stock market tends to trend upwards, and by staying invested in the market, you can potentially benefit from these long-term gains. On the other hand, if you try to time the market by trying to predict short-term price movements, you may miss out on these gains, or even suffer losses if you make the wrong move. Maybe you've heard that in the short run, the market is a voting machine, but in the long run, it is a weighing machine. It suggests that in the short term, the stock market tends to reflect the collective sentiment and emotions of investors, rather than the underlying fundamentals of the companies whose stocks are being traded. This is sometimes referred to as the voting machine aspect of the stock market, as the prices of individual stocks, or the overall market, may fluctuate based on how investors are feeling about the market or a particular company at a given moment. However, it is important to note that in the long term, the stock market tends to be more of a weighing machine, as the prices of the stocks and the overall market tend to be driven more by the underlying fundamentals of the companies and the overall economy. This means that over the long term, the stock market tends to reflect the actual value of the companies and the economy, rather than the collective sentiment of investors. If you stick to those mindsets, you will already have a great foundation to become a good investor and generate good returns in the stock market. With that being said, I'm going to end this video right here. Thank you for watching, and see you next time.